Hello, I'm Juliette Sarli. In this week's edition of IG Macro Intelligence, we take a look at the ongoing conflict in the Middle East and its impact on commodity and equity markets. Oil prices have spiked amid the conflict as shipping flows through the vital Strait of Hormuz grind to a halt. Brent crude initially spiked as much as 12% to above $80 a barrel when markets in Asia opened following the initial US-Israeli airstrikes on Iran. US President Trump has indicated he doesn't expect the fighting to last more than a few weeks. However, analysts say if the conflict is prolonged, Brent crude could soar to $100 a barrel.
Key question is going to be the state of shipping in the Strait of Hormuz. As of now, it has come to a near standstill through the weekend, primarily because of shipping companies and oil majors and traders suspending activity there as just as a matter of precaution. And of course, we saw insurers also ripping off their earlier contracts for cover and jacking up rates. So that combination has created a disruption, a suspension, one should call it. But should this war prolong, become much worse, Iran start actively trying to disrupt or stop traffic in the Strait of Hormuz, I should underline that hasn't happened so far. But should that happen, then all bets are off. And that's the scenario in which one is looking at triple-digit prices for oil.
Reserve Bank Governor Michelle Bullock has indicated implications for Australia are mixed, given we are a net energy exporter.
The other possibility is that if this is a very prolonged conflict and there is a very, very elevated and lengthy rise in energy prices, this ultimately is going to feed through into economic activity. And I think uncertainty, if people are paying more for their petrol, they've got less money to spend on other things.
Well, energy stocks listed on the ASX have spiked in the wake of the surge in crude oil prices. Woodside shares up around 20% over the past 12 months. ASX technical data showing shares in a strong bullish trend, as confirmed by multiple indicators, specifically the 5-day moving average above the 20 and 50-day moving averages. A longer-term bullish signal is also implied by the 200-day moving average, which is also trending higher. Morgan still favours Woodside along with Amplitude Energy, noting their operational and strategic investment case hasn't changed. And Morningstar is also up.
The majors in Australia, Woodside and Santos, we've seen them as undervalued for quite a while. The market has historically priced them on very low multiples, effectively saying no growth, writing off a lot of their potential expansion projects, which we think is overdone. What I would say about these events, though, is they really exemplify the geopolitical option that is embedded in oil stocks. They tend to be the beneficiaries of disruptions in this very volatile part of the world. We don't just like them because of that, but it is a nice attribute to have in a stock when you are exposed this way to this sort of geopolitical disruption.
Well, escalating geopolitical concerns have also sent precious metals soaring, bullion inching closer to all-time highs reached in January. A renewed pullback from bonds and currencies, the so-called debasement trade, has injected fresh momentum into what has already been a multi-year surge.
Gold sitting around 5,300 US at the moment still doesn't look like it's any time of it starting to pull back at any stage. And if this unrest continues, it's a natural haven for people to go to. So, yeah, it's an interesting position, and you don't want to be putting the kitchen sink or everything into it, but certainly having a good 5% of your portfolio is a good strategy at the moment.
The gold sub-index on the ASX hit an all-time high immediately following the attacks, with Evolution Mining and Northern Star rising significantly. Brokers upbeat on the outlook for Northern Star, with the average target price as surveyed by Refinitiv at $31.51, around 3% higher from current levels. A combined $22.5 billion was wiped from global air stocks in the immediate aftermath of the weekend airstrikes. Airline analysts have warned of weeks of travel disruption amid the airstrikes, with key Middle Eastern hubs facing closures and extreme delays. Qantas shares have dived in the wake of the attacks, with CEO Vanessa Hudson indicating the spike in oil prices will have a significant impact on the aviation industry, while also saying the airline has a, quote, pretty good hedging in place. Despite the recent turbulence, analysts are bullish on Qantas. Macquarie has an outperform rating on the stock, continuing to back earnings growth from Qantas's fleet renewal, cost discipline, and Jetstar momentum, which it forecasts will offset softer international conditions. And Jason Todd from 10Cap is warning against knee-jerk reactions.
Broadly speaking, look, if you're more concerned than we are around the Middle East, then obviously energy, precious metals are a good hedge. I think that has been discussed a lot of times on the program. And on the other side, you're shorting the travel stocks as a result. But I don't think that this is a real sort of risk-off moment for markets.
And that is your IG Macro Intelligence. We'll see you next time.